Good evening, everybody, and welcome to another financial wellbeing webinar with Mattioli Woods in conjunction with Rugby League Cares. This is our second webinar of quarter three, and it's turning into a real enjoyable evening on these Wednesday evenings where we have Adrian and Mark present some wonderful stuff around the financial well-being and the importance of it. So this evening, I know we've got a really good and exciting webinar planned with Adrian this evening, who's going to be looking at things around pensions and long-term savings. So without further ado, I will hand over to the expert, which is Adrian this evening. Thank you.
That is a very big build-up, Steve. Thank you very much. I'm conscious that you're going to be having me talking about pensions for the next 45 minutes, and this could be a really, really boring session, but I promise you it won't be. Actually, the topic and the subject of long-term planning or long-term financial planning for the future is actually quite an interesting one. And the world of pensions and long-term savings are full of acronyms and jargon. And I promise I'll use none of that on the way through this session. All we're doing with this session is just trying to improve our understanding of how pension schemes work and what we can rely on, what we can expect from certain areas of our finances and from government as well, to look after us when we reach a point where we want to end full-time work and perhaps move into being part-time employed, and then obviously transition from being part-time to being fully retired. Now, I know it sounds a long way away to a group on this webinar who are relatively young. However, can I remind you that if you're building a financial plan for yourself, then you've got three main areas that you should always look at: your short-term financial planning, your medium-term financial planning, and it won't surprise you to know about your long-term financial planning. And this session is really just to help with your overall understanding of your long-term financial planning. So I'm going to be committing all of my next 45 minutes to talking about that. Now, just because the session's being recorded, I do have some legal bits to go through at the beginning. We do this every time, but my lawyers will shoot us if we don't actually say it. So all the information that we're delivering tonight is correct at the time of this recording taking place to the best of our knowledge and is relating to the 2024-25 tax year. Obviously, we will have a budget from the new government in autumn, which will come into effect for the 25-26 tax year, which starts in April next year. And so there may be changes along the way, but we're delivering this now with the information that we've got to hand based on this current tax year, and everything should be about right. Also, really, really important to stress, I'm not giving you any financial advice whatsoever as part of this session. We're trying to take an objective view of the topic and the subject that we've got in hand tonight. So I'm not saying you should do this or you should do that. I'm just trying to give you more information so you've got a good understanding of the subject. And hopefully by being informed or being better informed, it might lead you to make better decisions along the way with your long-term financial planning. Now, again, with all the sessions, the usual introduction, you will see on the right-hand side of your screen, there is a section. On the top of it is a tab, says Q&A. Click on the tab, it opens a text box underneath. If you want to ask a question, put your questions in there. Mark will answer them as we go along. I'll also call on Mark at the end to come back on. If there are any popular questions, then we'll review them and we'll talk about them. Because this is part of the recording, so future people who might watch it back will probably have the same questions that you've got. So please do put them in there and we will address them at the end. I should also say, if you do ask a question, it's in private and it's in confidence, so it's not broadcast to everybody else that's on here. Only you can see that question and only you can see the answer coming back. So Mark's got lots of people firing things at him sometimes and he's replying to different people in different places. So please keep him busy because he's got nothing else to do for the next 45 minutes while I run through these slides and talk to you about pensions and retirement. So I think to set the scene before we start, I think it's worthwhile sitting down and thinking about what retirement actually means to you. Now, if you cast your mind back 20 years or 15 to 20 years or so, and if you were in a workplace like I am now effectively, then you would have had a date when you were going to retire. and they'd throw you a party on a Friday afternoon and they'd present you with a carriage clock or a wristwatch. And then on Monday morning, you'd have nothing to do. The world of retirement has significantly changed since then. We no longer have default retirement dates, so you do not have to retire. You can carry on working in different careers for as long as you're mentally and physically capable of doing so. You can also decide for yourself when you might want to step back either fully from employment, or the most common way of dealing with it at the moment is that people transition into retirement. So you might be doing a 5 day a week job. I'm certainly playing rugby league, maybe more than that. But when you get out into the workplaces and your second and your third careers, you might be working 5 days, compress that down to 4, maybe even compress it down to then 3. And then that's how people are transitioning themselves into retirement. But if we're going to do that, we need money to pay for that, to top up our income so that we still have as much money as we had before or can afford to live. But the main thing that I want to stress is that the world of retirement has changed. And if you pick up a copy of the Oxford English Dictionary and you look up the word retirement, you are hit with a long descriptive list of words that tries to describe what retirement is. And in there, you'll find words like retreat, and solitude and isolation and obscurity. And we just hope that your retirement plans will be nothing of the sort. First of all, we're expected to work for longer. Now, that is a good thing, believe it or not, because I would expect by the time you're thinking of being retiring or semi retiring, you'd have found a job that you actually enjoy doing with people that you enjoy being around. And so you keep your social groups active for longer. Also, there are a number of people who are going on to do various different things with their retirement and have different plans in order to fill the extra time that they've got available. And I would instill a sense of everyone on the webinar taking some time out to actually think about what interests you, what aims, what objectives have you got. I can't decide for you, but anybody on here who says, I'm going to go on holiday for my retirement, you're just not going to be able to manage that. Because if you're anything like me, you think, oh, I can't wait for the 2 week holiday. But then after 10 days of the holiday, you're itching to get back to something. You're itching to get home and crack on with something. And so holidaying for the rest of your life isn't really an option. Just some things to highlight to you. There's a huge increase in the numbers of people going back and sitting exams and qualifications in their semi-retirement. I have a friend of mine who retired abroad, and he came back to the UK to sit a French degree. And I said to him, why are you studying French? Because he was in an English-speaking country. And he said, it was just something I really enjoyed at school, but I never had the time for it. And so I've come back and I've done a degree and passed my qualifications in it. So there's all sorts of things to fill your time. But there is a dangerous one when you're thinking about your long-term financial planning, and that is that you've not thought about it. Because just in the same way as you need a plan to have enough money to do all the things you want to do, you need to actually have a plan as to where you're going to be and how you're going to fill that additional time. Otherwise, we're back to the 20 years ago scenario where you retire on a Friday, nothing to do on Monday, and you don't actually live that long after you fully retire. So social groups, keeping active and having lots of pastimes is good for us. And then, of course, when you've got a plan as to what you want to do and how you want to structure your retirement and transition into being fully retired, we've got the question of being able to afford it and have enough money to look after ourselves. So we're down to the question of why bother saving. Well, traditionally, we use pensions to save for retirement because of the advantages of doing so. We've got tax advantages, we've got employer contributions on them. So overall, it's kind of the number one way to save for retirement. There isn't a different product that could be recommended that is as good as a pension scheme to be a member of because of those reliefs. But what happens if we don't bother? Well, you will probably end up with the state pension system that we have in the United Kingdom. I don't think we have anybody on the webinar who is an overseas player in the UK, but we're going to cover the state pension anyway. And I think it's actually quite interesting because at the moment, since April 2016, we have a new state pension system called the single tier flat rate state pension. Now, that's a real mouthful, so I'm not going to say it again. Currently, that's £221.20 a week. In order to achieve that, you need to do 35 years worth of qualifying national insurance contributions or national insurance credits. So if we have partners or spouses who are maybe raising a family and take time away from work, if they have child support, they usually get a national insurance credit that goes with that as well. So everybody should be building up to getting the state pension. The minimum number of years to qualify for state pension is 10 years worth of national insurance contributions, if you like. And then you receive a proportion of that money, not that a full amount. But after 35 years, you can expect something around £221.20. Now, for everybody on here, you're looking at that thinking one or two things, either, oh, that's quite a lot, or that's nowhere near enough. And both groups would be right. It's not enough to lead a comfortable retirement on, but it is quite a lot of money, because if you multiply that up, that's £11,502 per year. So 11.5 grand's worth of income a year. Now, most of us, and I appreciate not all of us, but most of us will be living with a partner or a spouse, and they may also be entitled to receive the full state pension. So with these figures, we could well be talking about a household income of 23,000, just over £23,000 a year. So it is actually a good state pension system, and hopefully it remains that way and no future governments meddle with it. So if we do absolutely nothing to look after ourselves, this is what we're going to be left with. And then we need to put that into the context of our overall financial planning. Now, there are loads of ways to save up for later life money, or pensions, or retirement, or income in later life. We can use ISAs if we want to, which is not tax-free on the way in because we've paid tax on the money. But when we remove the money from the ISA, it's from a fully tax-free source. So I would argue that that's very complementary to pensions, which are the other way around, in that we get tax relief on the money on the way in, but only 25% of our money is tax-free on the way out. The rest is classed as income taxable. I will cover this a little bit later on so I can explain how that works. Buying a second property might be a good investment for the future. Again, we could release the value of those properties and we could create lots of income from that as well. We might have investments and we could sell stocks and shares to pay for ourselves. Whatever your plan is, I do think it's worthwhile after this session just taking some time out to think about where you're heading to and what you're going to need when you get there. Now, later on in the presentation, we'll have a look at how you can actually create income from pensions, because it's all right paying money in, but we want to know how to get it back out again later on. And so I'll look at that later, and that should give you some idea of how much you might be able to get as a regular income from pensions. But this slide, nevertheless, is important because from a financial planning perspective, you've got lots of different options, but if you do nothing, you may end up with a substantial shortfall in the amount that you need to look after yourself in later life. And that's not even including things like the cost of care in very late life. So I want to move on, and our standard slides say looking at your pension scheme. I'm going to generically look at pension schemes because I'm aware that different people on the webinar may well be members of different pension schemes with different clubs or different organizations. Each one may be slightly different, but all of them work in exactly the same way. So I'm going to stick to the very general principles of how your pensions work. So hopefully you've got a bit more of an understanding as to the mechanism in them. And I'll point out some important bits on the way through as well. Now, all of the pension schemes that are operated around rugby league, all of the pension schemes that operate in all of the workplaces across the UK, with very few exceptions, are known as group personal pension plans or defined contribution pension schemes. You don't need to worry about the terminology. The most important part of this is that you have your own individual account. I want you to think of it as just a big savings account, which you can't get access to until you're over the age of 55. That's soon to become aged 57 in the year 2028. But nevertheless, at the moment, over 55, you've got this big savings account, the money's being invested for you, and you can get access to it and do what you want with the money. Now, on the way through your various careers during life, each place that you come to will offer you the opportunity to join their pension scheme. And you may end up with a number of different pensions. I'll come on to that a little bit later on, but I want you to understand that each one of those accounts is yours. It belongs to you, your name, your address. You can decide what to do with the money that's in there. It's a personal account. There are what we call annual management charges. There are fees to pay for the company that looks after each of those pensions. They can't be over 0.75% of the value of your pension. The way in which these charges work is that you take that charge, you divide it by 12 of the value of your pension, and then they take that amount of money out each month as a fee or a charge to look after it. The industry average is typically around 0.5% of the value of your pension, which is incredibly low for the amount of things that they offer you in their services. Things like free transfers of pensions, investment options, and fund switching, things like that. I'll come on to that in a little while so you understand how that works as well. But these are, rates that were set when the pension freedoms and changes came into place in 2016, which is when the state pension changed, and with the new freedoms that we now have for pensions. And again, I'll look at those a little bit later on. So we're often asked, well, why should I bother paying into a pension? Well, quite simply, for the reasons I've already spoken to you about. You get tax relief on the money that goes in. Just to quantify that, that's money that would have gone to the inland revenue in tax take, goes into your pension instead. Now, if you don't join the pension scheme, you don't get the tax relief. You end up with a little bit more money in your pocket, but the chancellor also ends up with more money in the tax take. Whereas if you pay it into pensions, you get tax relief. Then you also have a club or a company contribution on top of that as well. A lot of pension schemes have something called a matching ratio. You might pay 4%, they pay 4%, 8% goes into your pension. Now, your 4%, let's say it cost you £2,000, you get tax relief on it. So it's probably only worth £1,600 in your pocket or £2,000 in the pension pot. Then you have that matching element on the top. So for every time you pay money into it, we're talking about something in the region of 150% uplift on what the value of that money is worth that you're paying into your pension pot. So when you consider this, it's difficult for me to say, why don't you put your money into an ISA? You don't get any of this in an ISA. Why don't you put your money in property? Well, you don't get that with property. I think there's a balance to be had. Those other things like ISAs and property and investments have a role to play alongside pensions, but this is the main reason why pensions are so advantageous. And of course, you pay in, your organization that you're a member of, be that a club, a company, an overarching body, they also pay into the pension. It moves across into your plan. It goes in on a monthly basis, and that money is probably going to sit there, depending on your age, for 10, 20, 30, possibly even 40 years if you're incredibly young, and be invested for you and have the chance to grow. Now, when that money goes in, you'll often hear the words that it's going into a default investment. Again, it's really simple. It does exactly what it says on the tin. If you don't want to make any investment decisions with that money, they will have created a default investment strategy which you will be a part of. And that is designed to be as useful for as many people as possible who don't want to make investment decisions. And lots of people do stay in the default investment option with pension plans that operate in the UK. Again, each pension plan is slightly different, but they all roughly do the same thing. They invest in a balanced portfolio of things. When I say that, it's jargon, but it means stocks and shares. It means property, it means bonds, it means gilt, it means global markets, it means interest bearing investments. Lots of different things all in one pool that you are a part of, which we hope grow over the next 10, 20, 30 years. You can, of course, make investment decisions if you want to. I'll come on to that in a little while. One thing I think that's common with sports people, particularly with rugby players, is you may play for multiple clubs on the way through your career, and each club will have a pension scheme, and each one will automatically enroll you into that pension scheme, regardless of whether you want to be in it or not, because you have to be in that scheme before you can decide to leave it and come back out. I would say, knowing what you know now about the uplift and the tax relief and everything like that, think twice before coming out of the pension scheme. But you do have to be in it first before they'll allow you to opt out of being in the pension scheme. As a result of that, lots of players have lots of pension pots behind them. There is no issue with having lots of pension pots. Remember, it's just like having lots of savings accounts. And at some point in the future, you can close and condense all those different savings pots, pension pots that you have into one or two just to make it more easy to manage. Um, I do want to just underline the money and paying money into pensions. Now, we have lots of legislation and lots of budgetary requirements, and things did change quite significantly in the last budget as far as what money you can pay into pensions. The annual limit that everyone has used to be £40,000 per year, so long as you had earnings over 40,000, I should say, and it increased to 60,000, which meant for people who are particularly established players, it gives them more advantages to put more money into pensions if they want to. You don't have to, but increasing that limit has relieved some people, particularly high earners, with more of an ability to carry on saving into pensions, which they didn't have before. There's something called technical called the money purchase annual allowance, and I'll explain it to you as simply as I can do. If you happen to be over the age of 55, which I don't think anybody on the webinar is, but if you happen to be over the age of 55, something to bear in mind. If you're over 55, you are drawing a taxable income from pension, but you are still working, you'll have a new allowance which drops down from £60,000 down to £10,000. Now, you might think that's very restrictive, and you'd be right, but the reason for that is really easy to understand. What the government don't want you to do is to draw money out of one pension pot and then pay it straight into another pension pot and get tax relief on the money going in, which you already enjoyed tax relief on when it originally went into your pension scheme in the past. So it's to avoid that double tax relief bubble, and that's why your 60,000 would immediately drop down to 10,000 if you're in receipt of taxable income from a pension scheme. I'll explain tax a little bit later on. I promise it's not difficult to understand. It's very easy. Lastly, very quickly, we used to have a maximum amount of money that anyone in the UK could pay into pensions before being penalised by 55% tax. You did hear me right, 55% tax. And that was £1,073,100. Not many of us are going to get up to £1,000,000 in pension pots, but if you did go over that, the tax was fairly horrific on it. That's been removed, so there's no longer an upper limit. So again, as you work through your career, you shouldn't worry about going over any limits or having any horrendous tax bills. If you're super successful on the way through your life, you can save as much as you like into pensions, subject to that annual allowance of £60,000 a year. And once that money's been deducted from you, remember it's had the uplift of tax relief, and then it's also had an employer or an organization's contribution on the top of it. It's sat in your individual account. Now you can just leave it there and let it grow with that default investment choice that I spoke about earlier. And that default investment choice is very middle of the road. It's not so risky that they're going down the casino with that money, but it's not so unrisky that it's all held in cash and is not really growing. It is in investments, but very medium risk and fairly conservative to be as useful to as many people as possible. Well, option one for you with the money that you have in pensions is to just leave it in that default investment and let it grow. That default investment is specifically designed to be as useful to as many people as possible who don't want to make investment decisions. But you can, if you want to, make your own investment decisions. Now, you can choose investments from a really wide panel of different investment choices. You might say, well, I want to invest in the NASDAQ. Well, there'll be a NASDAQ fund. You might say, well, I want something sparkly like gold. Well, you can invest in gold. You can invest in bonds, fairly low risk. You can choose whatever it is that you want to invest in. With the company that's looking after your pension, if you go onto their website and log in, there will be various different options. You don't have to move your whole pension fund into something else. You can take just a little bit of it and move it across to another fund, and you can see how it goes. And if you don't like it, you can move that little bit back. The only thing I would say is that some of the other funds that are operated by pension companies might have higher annual management charges just because they're specialist and because there may be an external fund manager who's managing that fund on behalf of the pension company that you're a member with. Your third option, if you want to, and you're unsure about all of this, but you think you might want to do something about it, is to seek financial advice. It doesn't have to be with us, it can be with anybody. There are loads of really useful websites like Find My Local Advisor. There's also the FCA website that you can go onto and find all advisors in the UK. There's lots of places where you'll be able to find a financial advisor. Again, I'm not selling anything on this webinar whatsoever, but we're also here to help with that as well. So we can offer you guidance and help. Maybe stop short of the financial advice bit, but that's what we're here to help with. So if there's any questions or queries on that, you can come to us and we'll try our level best to help you. One really important thing with the invested money that you've got in your pension scheme when it's gone in there is I think it's a really good time for you to think about what kind of an investor you want to be with that money that you've got there. You can leave it in the default all you like, absolutely sure. You can go into specific things like low risk in cash, or high risk would be kind of multi-asset global stock market funds. I know it all sounds very alien, but I personally want to invest in things that have a greener policy behind them. So I want to avoid things like oil and gas and tobacco production and plastics production and things like that. There are funds that are very ethical in their approach to the way the money is invested. So again, I would have a look into that. And especially if you've got any particular religious reasons why your investment choices might need to be different. Again, there are funds with all the major pension providers that are suitable for anybody who has any particular religious beliefs, and their investments need to go down those lines as well. So it is actually a really interesting world once you spend some time actually looking into it and having a look at your choices and where your money might be held. And you might choose to pick something a little bit more ethical or a little bit greener. Now, I've already mentioned this a couple of times on the way through, and the aim is not to confuse you in any way, but there were lots of pensions legislation changes about 8 years ago in 2016. The pensions minister at the time brought these in, and what it meant was that we've got total freedom as to what to do with the money that we've got in our savings, pension plans, when we reach the age of 55, remember soon to become age 57 in the year 2028. And total freedom means absolute total 100% freedom. You can do whatever it is with the money that you've created in those pension savings accounts. You didn't used to be able to, but you are now. But with that comes the question of, well, what should I do? Well, I can't really answer what you should do to get money out of pensions without telling you the various different options that you've got available to you. So I'm very quickly going to run through those, because it's all right paying money in, but we really want to know how we're going to get it back. And this is a slide which helps you with how you're going to get your money back. 25% of anything that you hold in a pension pot is classed as tax-free cash. Remember, you've got total freedom as to how you use that. So you can draw bits of it down at a time, or you can have the whole lot given back to you. You don't have to do it age 55. You can do it whenever you want to. But 25% of that valuation is a tax-free amount of money. After that, I think most of us are interested in how we can create a regular income from them. And the traditional way of doing that would be to buy an annuity. And I'll cover annuities in a bit more detail in a minute, but that's handing over all your money to an insurance company. They work out how long you're going to live for, and they give you a regular income for the rest of your life. But when you pass away, the annuity tends to pass away with you. You can defer taking the money. There is no need to take the money at 55. There's no need to take it at 60 or 65 or 70. If you don't need it, you can leave it there for as long as you like. It is your account, your money. You don't have to do anything with it at all that you don't want to. And there are no deadlines. You can draw down money from your pension saving pot. Quite literally, you can have what you want when you want out of the pot, but you do need to manage that yourself to make sure you don't run out of money. And lastly, if you're really not interested in any of this and you just want all your money back, fine. You can close it and have all your money paid back to you in one lump sum of cash. But remember, 75% of it would be treated as income. And so it would be income taxable. So at your rate of 20 or 40%, I'll show you a quick example in a second as to how that works. First of all, annuities are a really interesting area. Okay, they're very complicated, but the very basics are you're going to take a pot of money, you're going to give it to an insurance company. They're going to try to figure out how long, based on the law of averages, that you're going to live for, and then they'll make you an offer of a regular amount of money for the rest of your life. Now, there are hundreds of ways of setting these up, sadly. You can have an increasing one with inflation. You can have a flat rate income one. You can have a spousal pension built into it for your partner. Should you pass away, they will receive a part of that pension money as long as they live as well. If ever you're thinking of buying an annuity, you must see an annuity specialist to get the right one for you and build it appropriately to what you want. It won't surprise you to know that if you're already thinking the same lines as me, that if they're trying to find out how long we're going to live for, if we do something that shortens our life, they'll give me more money. Now, I'm not telling you to go away and take up skydiving, smoking, or dangerous sports or anything like that. But on the sensible side of things, if you do have any life-limiting health issues, you may be entitled to something called an enhanced annuity. This is why we need to speak to a professional annuity provider or an advisor to help us work our way through this. But essentially, anything that might shorten your life will lead to you getting more money from that annuity, because quite simply, they don't think you're going to live as long as the average person would do. So it's actually quite an interesting area, but quite complicated. I said to you earlier, I was going to give you some ideas as to how much stuff's worth. I've got some examples that follow on from this with each of the different options you've got, and I'm going to use the value of £100,000. So if you had £100,000 in a pension pot, what would you get? Well, again, there are lots of variations on the annuity theme, so give me plenty of rope to hang myself here with. But the two most popular types of annuities are an increasing annuity and a fixed annuity. You don't need to be a genius to work out how they work. The increasing one goes up every year by an indices like inflation or RPI or CPI, the cost of living. A fixed annuity pays you exactly the same amount of money every year. It never goes up. It just stays the same right through your retirement. If you had £100,000 and you were a totally average person with a totally average life expectancy, living in a totally average area of the United Kingdom, because where you live can affect the annuity rate, believe it or not, then a increasing annuity for £100,000 aged 60 would start at around £5,300 a year ish increasing, and a flat rate annuity would start and stay the same at £7,250. It starts higher because there's no future increases for the insurance company to build into paying you, so it's flat rate all the way through. Hope that helps. 100,000 and those levels on those types of annuities. Now, they're not very popular at the moment. And the reason is because it's your account, it's your money, and you can decide what you want when you want from the pension pot. Just like a big savings account with that tax relief built in for everything that's gone in on the way into the pension scheme. So you can take out what you want when you like. You can draw down funds from the pension pot. It's called being in drawdown or income drawdown. And you can draw down funds. And one year you might want to go on the holiday of a lifetime and have more money. And the following year, stay at home, just pay the bills and take out less money. The key thing here is that you'd have to manage your own pension pot. And when it's gone, it's gone. Nobody's going to top up the pension and the state's not going to provide for you. So it's up to you to manage that. Remember, all we have is the state pension, and that is that fixed amount on 35 years worth of NI contributions. So they're not going to build it up. So let's look at another example of £100,000 and how you might decide to look at it. Again, we've got somebody who's age 60, and what we're going to do with our 100,000 is we're going to take out £7,000 every single year on the way through. Now, the money is going to stay invested in probably a low risk investment, but we might have something like 5% growth on that money that's left there within that pension scheme. And this is based on the law of averages. You can see the balance of the account slowly erodes away. And if you had 100,000 with 5% growth on the money that was there, taking £7,000 a year out, the money's going to run out just after your 83rd birthday. It's 83 years and 3 months. The average life expectancy for a man in the UK is the average life expectancy of men and women rolled together in the United Kingdom is 81. So you've already got money that's lasting past the average. However, 1 in 4 people who are working in the UK are going to live into their 90s. And you'll probably be one of the 4 that lives into the 90s, and this money's run out. So again, you can manage it yourself and have what you want, but you need to make sure you don't run out. And lastly, I just wanted to cover off that important one that I said before. If you don't want to be a part of pensions in any way, you've got money stuck there, you just want it all back, yeah, fine, close it, have the money back, no problem at all. I'd suggest holding it in £20 notes under a mattress, and every time you want to pop down the shops, you just slip a 20 out and go and spend that and get your shopping. If you had £100,000, which is the same example we've been using so far, then there's a calculation to be done here. Now, this person, Alan, in our example, doesn't have any other job, so he's got no other income. Remember, I said that the first 25% of the pension pot is tax-free money. So in this example, that's £25,000, which leaves £75,000 to go into the tax system as earned income. Now, he doesn't have a job, so he's got a personal allowance, which is £12,570 in this tax year. So there's no tax on that either. But then the money hits the 20% tax bracket, and the money also goes into the 40% tax bracket. If you do a calculation, you get these numbers here, and there's a total tax bill of just short of 17,500 to get £100,000 out. Now, some of you on here will have already cottoned on to this and thought, well, yeah, do it over a longer period of time in different tax years. So take big lump sums out, but avoid that 40% bracket. You would exhaust the pot in 3 or 4 years, but you would avoid paying very large amounts of tax with it, and you could still get your money back that way. So just food for thought. I just wanted to show you how to get the money back, some of the different options that you've got, and the way in which, the tax system can trip us up if we're not paying attention, because this would be one way in which you'd end up with an unexpectedly big tax bill. One common question that we're always asked is, what happens to the money if something happens to me? If I'm not around, where does it go to? Well, it goes to your designated beneficiaries. Those are members of your family that you nominate to have that money should you pass away. A bit of a call to action. You've got to keep this stuff up to date. The tax situation depends on when you die. Excuse me. So if you pass away before the age of 75, everything gets passed on to your beneficiaries completely tax-free. Nothing to worry about whatsoever. And it's actually really simple to understand what happens to the money if you die over the age of 75. It still gets given to your beneficiaries, and they can still either take all of it out or they can take little bits out as and when they need it. But when they do withdraw anything out, if you passed away over the age of 75, which I hope you all do, they pay tax at their marginal rate on whatever they take out. So if they're a 20% taxpayer, they pay 20% on whatever they take out. If they're a 40% taxpayer, they pay 40% of whatever they take out. It's that simple. And you just report it to the Inland Revenue, send the money off to them. It's very, very simple. But it is a bit of a call to action to make sure that you keep your personal information up to date. I just want to remind you that it's your pension, you're in control. It's your name and your address, but you need to make sure that those details remain up to date. You definitely wouldn't have a savings account with tens of thousands of pounds in it and forget about it and not keep up with where that money is. You definitely wouldn't do that. But because it's pensions, people do it all the time. They go, oh yeah, it was part of that company I worked for 10 years ago, or I remember I was at that club, but I can't remember what pension I've got with it. It's a savings account. It's got your money in it. It's invested. You really need to keep up to date with where it is. If ever you need to find any lost pensions, there is a government pension tracing service, which I'll just talk about in some common questions on the next slide. There's a call to action to make sure that you've got all your information up to date. If you do nothing else after this webinar, just go away and make sure you've got the right name, the right address, you know where all your pensions are. If you don't, that's something that you need to do, because if you don't keep up with them, they'll get tipped off and written off and go into a big pot. So yeah, you need to keep in touch with them and try and get your money out of them. Now, Mark asked me before we started, what kind of questions do you think we're going to get? And I've put a slide together thinking I know what kind of questions we're going to get, so I'll try and answer them before we get there. But number one, common question: have I got to join the pension scheme? No, you don't. The interesting thing, though, with the legal side of pensions that employers and organizations have to offer their employees is that you have to be in the pension scheme before you can decide to come out of it. So if you joined a new club or you started a new job and you were put into the pension scheme, you can then say, oh, I don't want to be a part of it. They'd then send you your money back and you wouldn't have any more deductions. But you do have to pay that first one because you've got to be in it in order to get out of it. I hope that makes sense. No, certainly you don't have to join pension schemes. You don't have to pay in, but I'll remind you of what I said earlier, that you'll just end up with the state pension. The earlier you start saving into pensions or the younger you save, the easier it is to create a large pot of money, which you can use to look after yourself later in life. If you start in midway through your life to save in pensions, well, it's a bit late. It doesn't have long enough to grow as much as it could have done if you'd have started sooner. What do I do with pensions I've got from previous clubs is a very common question that we constantly answer all the time. Mark and I obviously speak to a lot of players and we get asked this question quite a lot. What do you want to do with them that you've got from a previous club? You don't have to do anything with them. Remember, it's your individual account. So long as you know where it is, then all's fine, because whenever you want to bring them together or leave them apart, you can do whatever it is you want with them. Now, a lot of people do decide if they've got 3 or 4 pension pots to consolidate them into one. And it's a common thing to do. It's easier on the paperwork. It's easier on nomination forms and things like that, should your personal circumstances change. So I do appreciate that you can do that. I think what you would normally do is use the last pension that you were a member of, contact them and ask them to close down the earlier ones and move them into that one. They do that for free. There is no charge for the pension providers doing that for you. The only thing I would say is they're not quick at doing it. It's not like just shutting a savings account and moving the money across. It's a bit more technical than that, because the money's invested. So those investments have to be consolidated before the money's transferred across. Can I save more? Yes, of course you can, subject to the limits that we spoke about earlier. So if you want to do over and above the minimum amount that's taken out for you to join the pension scheme, have a word with your payroll team. Tell them you'd like to maybe move up from 4 to 5 or from 5 to 6% of salary, and they'll do the calculations for you and they'll take the money out of your salary. It's not usual that you get more from your company or organization or club by paying more. It's worth asking the question, but they might not put more in if you put more in. But yes, of course, you can save more. The advantage of saving more is that you've got more tax relief from doing that. So more of it is going into pension. As I mentioned before, another common question is, I've got that pension from there, but I don't know where it is. No problem. You can go on .gov.uk, the government website. There is a pension tracing service, which is free to use. They're going to ask you some of your personal information, personal details. You pop them in there. They will go away and find all your pensions and report back to you where they are and who they're with, so that you can then write to them, get the correct name, correct address on those accounts, take ownership of them. And then we're back to the question of, can I consolidate them and move them together? Yes, of course you can, whatever you want to do. Where can I find more information on my pension plans is another common question. Listen, every single pension provider of any worth in the UK has a fantastic website which you can log on to. If you know you have a pension with them, try and log in. If it doesn't let you, tell them and they'll write out to you with a username and a password, and then you can log in, set your password, and from then on in you can control your own account. Now, the big players in the pensions marketplace, like Standard Life, Legal and General, Aegon, the list goes on, very big pension providers. They also have apps that you can put on your phone. So you can literally click a couple of buttons and you can see your pension, how it's invested, whether it's grown, what kind of annual management charge you're paying. All that information is really simple and to hand. So again, with the vast majority of pensions that you've got, you're probably able to get it on an app and keep up to date with it. They do lots of things through their websites. Remember that investment discussion we were having earlier? You can pick and choose investments using their websites. It's really easy to do. I promise you, it's not difficult. You can also read up about your pension and the default investment strategy that many people are a member of, to see how that money is invested and how how ethical that fund is as far as how that money is invested. Something which I'm quite passionate about. So you can go on and have a look at that. You can also nominate your beneficiaries on their websites as well, which is one of the most important things to do. If something happens to you, they need to send that money on to somebody else so they can have the benefit of that money. Just as an aside, actually, any money in pensions is outside of your estate for inheritance tax purposes. So it doesn't form part of your estate. You don't need to worry about inheritance taxes with pensions money. It just gets transferred straight on to the beneficiary. And remember, if you're under 75, they pay no tax on it. If you died over the age of 75, then they just pay tax at their marginal rate. It's very, very simple. So make sure that those details are up to date. It's just a bit of a call to action to get on top of these things, because I know lots of people who get their annual pension statement through and they have a look at it and go, I have no idea what that is. And then they put it in a dusty drawer and it never sees the light of day ever again. If you want help with that pension statement and you want to ask questions of somebody or get it explained to you, that's what we're here for. That's not financial advice. That's just help and guidance and assistance for you to understand the information that's in front of you. And Mark and I are more than willing to do that at any point if you need any help or any assistance to do that. So we've come through to the end of the presentation. As always, just as we're chatting and getting towards the end here, I'm going to point out my email address. It's on screen. I am here to help you whenever you need any help. I am not going to be delivering financial advice in any way, just assistance and guidance. And finally, players are starting to trust us and come through to us and chat to us on the basis that we have nothing to sell to you, only helpful and assistance through Rugby League Cares. And we were chosen by Rugby League Cares as a partner because we don't sell financial advice. So please, don't hesitate to drop us a note if we feel that we can help you in any way. Other than that, Mark's been dutifully answering questions in the background. How's it been going, Mark? Have I answered everything?
You have answered everything. There's been a couple of corkers, I've got to say, and one in particular. Those of you who are interested in pensions and property, I'd really urge you to watch next week's webinar where we've got a sort of mortgage specialist, and when we get more into the whole property and pensions piece then. But otherwise, you've covered all the questions. But I have to say it's been a busier evening than some we've had in the past.
Good, so I'm glad.
Very much appreciated.
If I have to work during the evening, I think Mark should also have to do a little bit of work as well. And thank you to Steve as well for being on the call and working through the evening as well. It really is a pleasure to have the ability to talk to you on these sessions. And I do hope that you'll join us again in the next quarter when we take on another challenging topic or subject and just try to help with the overall, financial planning and financial management and helping with financial well-being for players and those that are involved in the rugby league. So other than that, I am going to sign off for the evening and go and have my tea. So I wish you all a very good evening. I hope you have a nice time, and I do look forward to speaking to you again at some point in the near future. Take care, and bye for now.